Should you invest or exit based on market highs? Over the last few weeks, headlines and business channels have spoken about how the India's story is causing equity markets to do extremely well and hitting lifetime highs. This has been driven by strong foreign institutional flows, domestic monies, and resilient domestic demand. However, it's very important to keep in mind that investing decisions should not be made on the basis of 3-month performance or year-to-date performance, as these can skew numbers very significantly from an investor perspective. And what we need to keep in mind is that you need to look at slightly longer time frames to be able to at least get the correct picture. If you are thinking that this is a time to increase risk because you want a higher rate of return, you need to keep in mind that risk can sometimes increase disproportionately without necessarily increasing your rate of return. For example, if you look at data, you will find that markets have actually gone up in India from October 21 to July 14th, 23, from 18,500 approximate levels to 19,500 approximate levels, which means that the Nifty 50 has only delivered 3% per annum. If you look at other indices, including the small cap indices that are talked about so much, you will notice that the rates of return are actually negative. And even if you look at global markets, S&P 500, NASDAQ, the Stock 600, China, you will notice that all of these markets are actually lower than where they were at the end of 21. One of the big reasons why this has happened is because this coincides with the increase in interest rate cycle by the US Fed. So as an investor, what should you be doing now, considering that markets are at all-time highs and there is all this information around you that's screaming at you to participate in equities because of the strong macroeconomic story of India? Number one, valuations are critical to look at. Look very carefully at all the indices and look at whether they are overvalued, reasonably valued, or undervalued. And please ensure that you're looking at long enough time frames and not a short-term horizon. Number two, do not take investments decisions based on short-term 3-month or year-to-date performance, as this could end up meaning that you're chasing momentum and therefore likely to fall hard in case the direction of momentum changes. Number three, do not increase incremental risk in the portfolio without understanding that when things turn, and they can turn very suddenly, all the expected higher returns can evaporate. And therefore, do not invest in riskier assets simply because you believe there is no alternative. Number four, certainly look at partial profit booking. I think that's a good idea. It allows you to rebalance your portfolio. If some part of your portfolio has become overpriced, it allows you to move that money into safer assets. And this is exactly the principle of asset allocation that helps investors through these kinds of times where one can get greedy in this environment. Number five, if you have short-term financial goals coming up, say a child's education, marriage is just around the corner, be sure to look at your asset allocation and follow a glide path to reduce equity exposure gradually so that there is the ability for some of the gains to be protected and the risk to be managed. Last but not the least, do not try to time the market by trying to say, I want to move all the money from equities into fixed income. You invariably find that this does not work. And what might end up happening is you might end up holding all your money in fixed income, waiting for a particular level to get achieved, when it really does not happen at all. So all in all, I'd like to conclude by suggesting that be careful of the noise around you, make prudent investment decisions, follow your asset allocation principles, rebalance your portfolio if required, and talk to your investment advisor if all of this seems too much at this particular point in time. Let me also conclude with some disclaimers. Number one, investments in securities markets are subject to market risks. Read all the related documents carefully before investing. Number two, registration granted by SEBI, membership of BASL, and certification from National Institute of Securities Markets, NISM, in no way guarantees performance of the intermediary or provides any assurance of returns to investors. Number three, this information is only for consumption by the client, and such material should not be redistributed. Number four, the securities quoted are for illustration only and are not recommendatory.